Spend some time looking at some of the vocabulary and features of a specific company. So, when you're looking at a specific company, that company has a ticker symbol. The ticker is just a symbol that is used to represent that company in the stock market. So, for example, Walt Disney Company, their ticker is DIS. So it's basically just an abbreviation for the company. Each company operates in a sector, or each company operates in an industry. This is basically the area the company works in or the type of company it is. So, for example, Netflix is their sector is considered communication services, and their industry is considered entertainment. These are just categories that the company falls in. A lot of times, companies are compared to other companies in its industry or its sector to judge how good or bad of a company it is. Uh, Next word I want to talk about is this one, market capitalization. Market capitalization is how much the company is worth. So if you take how many shares there are out there times the price per share, that would be the market capitalization. Another way of thinking about this is how much would you have to pay to buy 100% of the company? These are market capitalization categories or sizes of company categories. If the market capitalization is over $200 billion, we call that a mega size. For a large size company, has a market capitalization between 10 and 200 billion. Medium, small, and here's micro. In general, the smaller companies are more volatile or changes more, bigger ups and bigger downs compared to your bigger size companies. So, when you are deciding whether or not a company is worth buying, there's a few different ways you can look at that company. There's a few different ways to measure the value of a company, whether it's a good or bad buy. One way is the PE ratio. The PE ratio is just the price of the share divided by the earnings per share. You can have either a trailing PE ratio, trailing means looking backwards, or you can have a forward PE ratio. Forward is obviously looking forward. So if you take its current price and divided current price per share divided by its earnings over the last 12 months per share, then that creates a trailing PE ratio because you're looking at the past 12 months of earnings. If you take the current price and then divide it by how much earnings you expect that company to make in the next 12 months, so you're looking into the future, then that would be considered a forward PE ratio. The trailing PE ratio, everyone can generally agree on because that's looking into the past. So you know how much money they made, you know how much earnings they had over the past 12 months. For a forward PE ratio, you have to kind of guess or estimate their earnings. So therefore, your forward PE ratio is only as good as that guess. Another way of thinking of PE ratio is how much would you have to pay for $1 of that company's earnings. So if you do this math right here and you get a PE ratio of 12, then that means you are paying $12 when you buy that stock for every $1 that that company is making in earnings, in profits. Let's do an example here. So let's say we have this company, company Q. One share of that company costs $25 right now on the stock market. The company made $40 million last year, and the company has 20 million shares out there. Okay, so the price per share is 25, said right here. Earning per share is $2. This is earning per share, so this is earnings divided by shares. So they earned $40 million last year, and there are 20 million shares, so 40 million divided by 20 million is 2. Because we're looking at earnings in the past, this is a trailing PE. So the price per share, 25, divided by the earnings per share of 2, means that this has a trailing PE of 12.5. One way to figure out whether this is a good PE ratio or a bad PE ratio is to look at it compared to the historical average for the S&P 500. S&P 500 is just the 500 biggest, most important companies in the US. So compared to the average PE for those companies over a period of time, would the 12.5 be high or low? That's one way to look at the PE ratio. Another very common way of looking at a company to see whether it's a good deal or a bad deal is the PEG ratio. The PEG is the PE ratio divided by growth. That's why PEG. If you do the trailing PE divided by how much has the earnings grown over the last year, then this is called the trailing PEG ratio. If you take the forward PE ratio and then divide it by how much do you expect the earnings to grow over the next 12 months, since both of these things are looking into the future, this would be called a forward PEG. Once again, this your forward PEG will only be as good as your guesses about its future earnings and future growth in earnings. Here's an example of the PEG. Let's say that company Q, well, it made $32 million 2 years ago. And then we said last year it made $40 million. Okay, so that means it went up by $8 million from 2 years ago to 1 year ago. So if it goes up, if it starts at 32 and then goes up by 8 million, that means it's going up 25%. So, uh, so since its trailing PE is 12.5 and its growth over the last year was 25%, its trailing PEG 25 divided by 12.5 divided by 25, its trailing PE would be 0.5. A common way of seeing or looking at whether this is a good PEG or a bad PEG, a rule of thumb, is that a PEG of 1 is considered a fair value. Anything lower than that is considered underpriced. That means like a good time to buy it. A PEG of greater than 1 is considered overpriced, too expensive. These are obviously rules of thumb. And there are cases where having a PEG of greater than 1 is still a good price to buy it. And sometimes a lower than 1 is not a good time to buy it. But those are just general rules of thumb. There are a lot of different ways to measure whether or not a company is a good buy at that particular price. Here are a lot of others. So there's no one way that everybody looks at it. There's no one guaranteed way that's going to definitely make you money. Okay, one more that I do want to talk about though is dividends. Dividends is a large part of the money people make in the stock market. Once again, the dividends is the money that the company is giving directly back to the people who own those shares. And it's usually said in a how many dollars per share. So you might talk about a dividend of $3 per share. So each person who has a share would then make $3 or get $3 from the company. A dividend is not guaranteed. A company does not have to actually give it to you. In fact, even if when you buy it, the company is expecting and telling people that they're going to give $3 in dividends for the next year, at any time that company can just decide, nope, we're not going to do it. So a dividend is never guaranteed. However, there are lots of people who buy companies specifically for their dividend. One key measure related to dividend is dividend yield. So if you take how much that dividend is per year and then divide it by the share price, you get this thing called dividend yield. So if I spend this much money buying this share, how much will I get back in a dividend per year? And this is usually represented as a percent. So a 6% dividend yield means for no matter how much money you put in when you buy shares, you are getting 6% of that back as a dividend for the year, assuming they pay the dividend that they said they would pay. So because this is a percent of getting your money back every year, often this dividend yield is compared to other yields for other more stable assets, or just compared to the yield of other assets. Because CDs and bonds, it's listed right when you buy it as this many percents that you're going to get. Um, this dividend yield is sometimes compared to that as a way to sort of think about, is this a good yield or a bad yield? Last thing I want to say, the stock market is a future facing place. In general, the price of stocks don't necessarily reflect what just happened recently. Instead, the price of stocks in general is reflecting how investors feel about the future. What investors think the future will look like. And a rule of thumb, uh, a general rule, is that in general, the stock market is a reflection of how investors feel the economy and that company will look like about 6 months into the future. This is why a lot of times uh, the way the stock market goes up and down is different than how regular workers are feeling about the economy. During a recession, when people are losing their jobs and regular workers might be feeling crummy about the economy, the stock market could actually be going up because if the stock market is predicting already that 6 months from then, the economy will already be improving. So this sort of explains the disconnect often between the stock market and how regular people feel about the economy. So you now have the money there in your brokerage account in order to buy stocks. So how do you decide what companies to buy? Well, companies fall into many different categories. So I'm going to talk about some of the categories for different companies, and you can use these categories to sort of decide uh, to narrow down your search of what type of companies you might want to look into. First, you have growth versus value. So one way of dividing up companies is into these two different strategies. And most companies use a combination of growth and value, but some companies fall more on the growth end, some companies fall more on the value end. So when you talk about a quote unquote growth company, this is a company that might not actually be making much money now, and in fact might even be losing money, but the company is growing very quickly or is promising to grow very quickly. Investors will buy into the stock in the hopes that once the company is large enough, they'll start making a lot of money. Many technology companies fall into this category. For almost every single technology company, when they first are a company, they make almost no money, and in fact, probably lose a lot of money. But they're growing very quickly. The amount of revenue, amount of money coming in, amount of product they're selling, or amount of people using that service is just growing very, very quickly. So even though they're not making money, they're still a company that some people might want to invest in. A very good example of this is Amazon. Amazon's revenue, or the amount of money coming in, has been growing about 20 to 40% every year for a while now. Here is a chart, or two charts actually. The blue one here is their revenue, how much money is coming in through the stuff they sell or the services they sell. And so as you can clearly see, it's been going up this whole time. This is each bar represents a quarter. If you notice these much higher ones, it sort of follows a pattern. You have this tall one and then three smaller ones, tall one, then three smaller ones. And that taller one represents the fourth quarter, where it includes Christmas. So typically, there's a larger bump here for Amazon during that fourth quarter. Now, here in the green, it is talking about revenue growth. How much higher is their revenue this year compared to the same time last year? And it has fluctuated, but in general, it's fallen between this 20 and 40% for now 14 years. So if they're growing their revenue so much, and how's their profit? So this darker line is their revenue for Amazon from 1997 to 2015. And this is in billions of dollars. And as you can clearly see, their revenue has gone up, up, up this whole time. This orange-ish line is their net income. It is how much money they bring in minus their costs. And as you can see, their net income has basically stayed pretty flat. If we were able to zoom into this orange line, you would actually see that they lost money many of these years. And they're easy to see that their net income is definitely not growing the same way their net revenue has been growing. So this is a clear example of a company that is trying to grow as fast as they can and worrying about profits later. Here is a zoomed in picture of just their profits for that quarter. And as you can see, this goes all the way back to 1998, 1997, and a lot. And here's the zero line right here. And a lot of these years, a lot of these quarters, Amazon was actually losing money all the way into 2014. It was still losing money some quarters. And even on the quarters that they did make money, it was not a lot of money. The 0.5 means $500 million, which is quite a lot of money. But let's look at this 2015-ish time when they made $500 million. If we look at the revenue in 2015, that was off selling about $105, $110 billion worth of stuff. So after selling $110 billion worth of stuff, they were still only making less than $500 million. So about 0.5% of the amount of money coming in do they actually get to keep as profit. So that's a clear example of a growth company. Let's look at value. So a value company sort of is categorized as the exact opposite. They're a company that is making a good amount of money right now compared to their stock price. And these value companies usually are growing, they're just growing very slowly. The industries that sort of fall into this value category tend to be older industries. So car companies, those companies tend to be value companies, phone companies, airline companies. These value companies may have grown really fast when they were first new companies, but by now their growth has very much slowed, and they've fallen into sort of this value category of slow growth, but are making money right now. These value companies also tend to pay an okay dividend. Okay, so there's your sort of value compared to growth. There's actually this third category that gets talked about a little bit less, income companies. And these are companies that have pretty high dividends compared to their stock price. They might be a company that actually gives back most of their profits to their investors as dividends. These income companies uh, will either be growing slowly or sometimes not growing at all. One sort of very stereotypical income company are utilities. Utility companies don't grow very fast. And when I say utility companies, I'm talking about your gas, your electric, your water. So these companies don't grow very fast, but they have a very, very, very steady income. People are going to use their electricity, people are going to use their gas. And so these companies have very reliable revenue, and sometimes they will uh, pay a lot of it back to their investors in forms of dividends. So you have this category of companies. They're either a value company, a growth company, something in between, which they might be categorized as a blend company if they're kind of right in the middle there. You have some companies that are categorized as income companies. Companies are also categorized by what type of business they do. We call that the sector they're in. And here are the 11 sectors that companies fall into. You have your energy, such as coal companies, gas companies, oil companies, material companies, uh, industrials. Uh, this might be your makers of, say, farm equipment. Consumer staples. Staples are the things that just people always buy pretty constantly. Your toothbrushes, your toothpaste, um, your soaps, paper towels. These are things that uh, people just regularly pick up. Consumer discretionary. The word consumer, by the way, is you and me, people who buy and then use it. Consumer discretionary are things that consumers don't have to buy, but that they buy. Uh, like I guess like jewelry would fall into this. A good amount of electronics fall into consumer discretionary. Then you have healthcare, financials. This is talking about banks, information technology companies. Um, like Facebook is an information technology company, so this is just technology companies dealing with a lot of information. Your Googles, telecommunication, phone companies, internet companies fall into this, utilities, real estate. These are the different sort of sectors that companies fall into. So that's one way you can look for a particular company you might want to invest in. Maybe you decide you think healthcare is going to be a great industry to be part of in the next 5 years. So maybe you'll start looking for healthcare companies to invest in. Companies are also categorized by where is that company. Two general categories, it's international versus domestic. Domestic just means that the company's headquarters is inside the US. International means that the company's headquarters is not in the US. International is also divided even further into developed and emerging. And the categories of developed companies, you can kind of think of them as the rich companies, the uh, rich per person companies, people with Yeah, and these countries are the U.S., Canada, Europe, Japan, New Zealand, Australia, Singapore, and there's a few more small countries that are also categorized in the developed country. I believe Israel is also in this category. The emerging countries are the rest. If they don't fall into this higher income category, then they fall into this lower income category. Companies are also categorized by how big that company is in terms of um, their stock market price times how many shares. So the price to buy 100% of the company. So this is what I mean when I'm talking about size or market cap. Cap here stands for capitalization. So a lot of times you can search for companies based on their size. These are the sizes I gave you in the previous video, but a lot of times on websites they will just show this: large, medium, small. Uh, Medium is a company with a market cap between 2 and 10 billion, where large is anything bigger than that and small is anything smaller than